In the first quarter of 2026, Berkshire Hathaway disclosed something that made financial headlines worldwide: a cash and short-term treasury position of $397 billion, the largest in company history. That's equal to more than a third of the entire conglomerate's market value. But the number itself wasn't the interesting part. The pattern behind it was Berkshire had been a net seller of stocks for more than a dozen consecutive quarters. It quietly trimmed Apple from nearly half its portfolio down to about a fifth. It cut its Bank of America stake by more than half. It sat out 21 straight months without buying back a single share, even near record highs. Most people would assume sitting in cash during a bull run is a mistake. Yet here was one of history's most successful investors doing exactly that, deliberately, for years. That contradiction says more about how billionaires handle financial crises than almost anything else. While ordinary investors chase a rising market, the wealthiest people are usually doing something calmer. They're getting ready, not for a specific crash date, but for the moment the market eventually becomes cheap again. And 2026 is a remarkably good year to study exactly how that preparation works. So let's walk through the pieces, one at a time. First, the market conditions putting investors on edge. The S&P 500 has traded above 7,600 this year, near all-time highs. But underneath, the market's internal health tells a more nervous story. The Shiller-Cape ratio, which smooths out a decade of earnings, sat around 41 in mid-2026. That's more than double its long-run average of about 17. Only 2 or 3 other times in a century of market history has it reached this level. Each of those previous instances preceded a serious multi-year drawdown. Market breadth has weakened too. The median stock sits well below its own 52-week high. Meanwhile, a handful of massive tech companies keep pushing the overall index upward. Only about 56% of S&P 500 stocks trade above their 200-day moving average, even as the index hits new records. Some veteran strategists call this the loudest warning signal since the dot-com era. The VSHA, Wall Street's fear gauge, has hovered in the high 20s this year, above its historical average. Much of the anxiety centers on one question: is AI infrastructure spending durable growth, or an unsustainable bubble? Megacap tech poured hundreds of billions into AI capital expenditures in 2025 alone. Projections suggest total spending could exceed $5 trillion by the end of the decade. At some companies, AI capex now consumes 3/4 of operating cash flow. That draws uncomfortable comparisons to the late 1990s. But there's one key difference. Today's AI companies generate real revenue and real earnings growth, unlike much of the dot-com era. So the honest view in 2026, a crash isn't guaranteed, but the odds of a real correction have risen substantially. This is exactly the environment where ordinary investors start checking their portfolios daily, stomachs tight. And it's exactly the environment where billionaires and family offices behave completely differently. We know this because several major 2026 surveys give us an unusually detailed look inside their thinking. UBS's Global Family Office report surveyed 300-plus offices across 30-plus markets. Average net worth $7 billion. 60% plan to change their strategic asset allocation in the next 12 months, the highest reading UBS has ever recorded. That's up sharply from just 35% a year earlier. JP Morgan's survey of 333 family offices found geopolitical risk topping even interest rates and inflation as the number one concern. A separate 2025 BlackRock survey found 84% of family offices naming geopolitical uncertainty as a critical allocation factor. That was the first year since the survey began in 2020 that overall sentiment turned negative. So what are they actually doing? The first consistent theme: diversification, far beyond the textbook version. UBS found 65% expect confidence in the US dollar's reserve status to weaken over the coming year. 47% describe themselves as overexposed to the dollar specifically. Close to a third have already cut, or are considering cutting, dollar-denominated holdings. They're rotating toward the euro and the Swiss franc instead. This isn't a wholesale exit from American assets. US family offices still show the strongest home bias globally. 88% of their portfolios remain allocated to North America. But the direction of the shift is unmistakable. Diversification is quietly expanding. The second theme, and the most visible one in 2026, is liquidity, cash, sitting and waiting. Berkshire's $397 billion pile is the most famous example, but far from the only one. Roughly $339 billion of it sits in short-term treasury bills, currently yielding around 7%. It's not idle money losing value. It's money earning a safe return while waiting for a better opportunity. Buffett was asked why Berkshire hadn't bought more after a modest pullback. His answer, a 5 or 6% drop, wasn't enough. Berkshire wasn't trying to make 5 or 6%. It was waiting for the kind of dislocation that creates truly exceptional long-term value. This pattern goes well beyond one company. Private equity is sitting on a genuinely staggering amount of what the industry calls dry powder, committed capital that hasn't been deployed yet, estimated between $2 and $6 trillion globally in 2026. This capital built up over years of cautious deal-making as managers waited for better entry points. Now, funds raised in 2022 and 2023 are approaching deadlines requiring that money to actually be deployed. An enormous wall of capital, larger than most countries' GDP, stands ready the moment opportunities appear. This is what separates billionaire behavior from everyday investor behavior. Much larger portfolio, not a dominant holding. It's useful because its value tends to move independently of stocks and bonds during periods of stress. The sixth theme is research and information as a genuine structural advantage. Over 8,000 family offices now exist globally, managing a combined $5 trillion. That's projected to reach $9 trillion by 2030. A growing share are moving into direct investing, bypassing traditional private equity fees entirely. 80% of family offices now outsource part of their portfolio management to specialized investment platforms. The point? Better information and rigorous analysis reduce the odds of an emotional, poorly timed decision. The seventh theme, and maybe the hardest to replicate, is emotional discipline. Markets are driven as much by human psychology as by fundamentals. Fear causes ordinary investors to sell at exactly the worst moments. Greed pushes them to chase whatever's rising fastest, right before it peaks. Wealthy investors aren't immune to either emotion. They're human too. But the infrastructure around them, advisors, long horizons, diversified holdings, cash reserves, acts as a guardrail. So what does this mean if you'll never run a family office or sit on a $397 billion cash pile? The underlying principles scale down surprisingly well, even if the numbers don't. A modest cash reserve, 3 to 6 months of expenses, gives you a taste of the same optionality. Avoiding high-interest debt matters at a household level just as much as at a billion-dollar level. Debt is what forces people to sell assets at the worst possible moment to meet payments. A reasonable mix of stocks, bonds, and real assets protects against the same concentration risk family offices worry about. A genuinely long-time horizon is available to anyone, regardless of net worth. It may be the single most powerful tool on this list because it costs nothing but patience. None of this eliminates risk. No strategy can. But the data from 2008, from 2020, and from whatever unfolds next points to the same conclusion. The investors who come out ahead rarely predicted the exact date of the crash. They spent the calm years quietly building the cash, the diversification, and the patience to act while others froze. Let's go back further than 2020 to see this isn't a one-time pattern. During the decade, including the 2008 crisis, aggregate billionaire wealth actually dipped about 6%. But over the following decade, the recovery decade, billionaire wealth grew by roughly 85%. Buffett spent the fall of 2008 at the height of the panic, deploying billions others were desperately trying to preserve. He put $5 billion into Goldman Sachs preferred stock, paying a 10% dividend, plus warrants on common stock. He made a similar move with General Electric. A few years later, he negotiated a $5 billion investment into Bank of America on remarkably favorable terms. That position became one of Berkshire's most profitable investments of the following decade. None of these deals were available to ordinary investors, not because of any legal restriction. Striking them required enormous cash reserves, the calm to negotiate while headlines screamed collapse, and years of patience. For most people, fear is the signal to sell, to get out, to protect what's left. For prepared billionaires, fear in the market is closer to a price tag, an indication that assets are marked down well below their real worth, simply because others can't hold them. Debt management explains why so many ordinary investors become forced sellers at exactly the wrong moment. Leverage works wonderfully when prices rise. It becomes a trap the moment they fall. Lenders can demand more collateral or repayment at the worst possible time, forcing a sale regardless of long-term logic. Billionaires aren't debt-averse. Many use leverage extensively, especially in real estate and private equity, but they use it in a disciplined way, matched against stable cash flows, backed by liquid reserves. This distinction, debt as a controlled tool versus debt that creates forced selling, applies to a mortgage just as much as a billion-dollar buyout. One useful framework here is Ray Dalio's all-weather approach. The idea, no one can reliably predict what economic environment comes next, growth or recession, inflation or deflation. So build a portfolio that performs reasonably well across all of them, rather than betting on just one. That typically means stocks for growth, long-term bonds for recession, inflation-linked assets for rising prices, and a modest slice of gold. Gold performs best when confidence in currencies and institutions is falling, exactly the conditions of a severe crisis. Gold surged more than 60% in 2025, pushing past $4,000 an ounce for the first time in history. Central banks drove much of that, buying at the fastest pace in decades. Yet the fact that 72% of family offices hold none at all is a useful corrective to the popular image. Gold is one insurance policy among several, not a dominant strategy. Fine art and collectibles are another asset class that shows up in serious analyses of ultra-wealthy portfolios. Paintings, rare wine, vintage cars, watches. Their value depends on scarcity and cultural significance, not earnings or interest rates. Because transactions happen privately, prices don't swing daily the way stocks do. That gives holders psychological insulation from headline-driven panic. It's a smaller, more specialized corner of billionaire wealth, but it illustrates the same principle. True diversification means holding assets that don't all move in the same direction at once. Back to 2026, stretched valuations, narrow leadership, geopolitical tension, and uncertain rates create exactly this kind of environment. Family offices aren't making dramatic, panicked moves in response. That restraint is itself instructive. UBS describes the shift as measured and disciplined, not a wholesale rotation out of risk. Family offices remain, in JP Morgan's words, predominantly risk-on, still exposed to stocks and alternatives. Staying invested while building reserves and diversification, resisting both fear and greed at once, is genuinely difficult. The infrastructure billionaires build around themselves makes holding that balance structurally easier. That, more than any secret formula, is the actual lesson in how billionaires prepare for financial crises. Not magic techniques reserved for the ultra-wealthy. A set of principles: patience, liquidity, diversification, careful debt use, and emotional discipline. Anyone can apply these at whatever scale their own finances allow. The numbers will always look different. A retiree's emergency fund isn't Berkshire's $397 billion war chest. But the underlying logic scales in both directions. Prepare during the calm periods, so you have real choices during the turbulent ones. And when the turbulence eventually arrives, because history says it always does, resist making your biggest decisions out of fear.